Ind AS 16. Property, plant and equipment. What is property, plant and equipment? Property, plant and equipments are tangible items which are held for use in production process or supply of goods or services for rental to others for administrative purpose and are expected to be used for more than one period. Bearer plant. Bearer plant means a living plant used in the production process or supply of agricultural produce which is expected to bear produce for more than one period and has a remote likelihood of being sold as agricultural produce except for incidental scrap sales. When bearer plants are no longer used to bear produce, they might be cut down and sold as scrap. For example, used as firewood. Such incidental scrap sales would not prevent plant from satisfying the definition of bearer plant. A recognition criteria of PP. PP is recognized as asset if and only if there are probable future economic benefits and cost can be measured reliably. Both the conditions need to be satisfied to recognize the PPE. Guidance on whether following items are to be recognized as PPE. First, spare parts. Spare parts, standby equipment and servicing equipment. They are treated as PPE only if definition and recognition of PPE are met. Otherwise, they will be treated as inventory as per Ind AS 2. Second, aggregation of individually insignificant items like molds, tools, dies. Aggregate individually insignificant items such as molds, tools, and dies and apply the criteria to the aggregate value if appropriate. That means these molds, tools, and dies will be aggregated and we need to apply the criteria to the aggregate value. Next, safety and environmental equipment. They indirectly assist other assets to achieve future economic benefits. Hence, they are considered as PPEs. So, safety and environmental equipment is a PPE. Measurement of PPE. Initial measurement of PPE. PPEs are initially measured at cost, always at cost. What are the components of cost if asset is purchased? First, that means cost includes purchase price, less trade discount and rebates, add non-refundable taxes, add all directly attributable expenses, which includes employee cost, cost of site, delivery cost, installation cost, cost of testing, less proceeds from sale of product arising from test production, professional fees. The important point is the excess of net proceeds from sale of items produced during testing will not be credited to P&L. It will be deducted from cost of PPE. That means there are some testing items. If any net proceeds received from sale of such testing items, it will not be credited to P&L account. It will be deducted from cost of PPE. Next, cost does not include inauguration expenses, advertisement and promotional cost, training cost, office and administration cost, other general overheads, initial operating cost, cost of relocating entities operations, the income and related expense of using under constructed PPE. For example, using a car parking site, they should be recognized in income statement directly. It should not be capitalized to cost of PPE. Cash discount, if any, will be directly transferred to P&L account. It will not be capitalized. That means it will not be added to cost of PPE. It will be directly transferred to P&L account. Next, cost includes cost of decommissioning or dismantling and the site restoration. It should be recognized at present value. Also, at year end, unwind the discount as the above cost of decommissioning has been recorded at present value. What is the journal entry for unwinding at year end? Finance charge account debit to provision for decommissioning. Next, deferred consideration. If payment is deferred beyond normal credit terms, then the cost of PP will be cash price equivalent at the recognition date. As on the date of recognition, it will be the cash price equivalent. The difference between the cash price at recognition date and the total payment is recognized as interest expense over the credit period. Next, what are the components of cost if asset is self-constructed? Use same principle as above discussed purchasing asset. plus we need to recognize the borrowing cost as per Ind AS 23. What if asset was acquired by way of exchange? If asset was acquired by way of exchange, in such a case, in case of exchange of assets, first preference should be given for fair value of asset given up plus cash paid, if any, or fair value of asset acquired, whichever is more clearly evident, provided the transaction does not lack commercial substance. Second preference will be given for if fair value is not available or if the transaction lacks commercial substance, then record PPE at carrying amount of the asset given up plus cash paid, if any. A transaction lacks commercial substance if future cash flows, that is a risk, timing and amount, are not expected to change as a result of the transaction. That is, cash flows from newly acquired assets are going to be the same as the cash flows from old transferred asset. That means transaction lacks commercial substance. Next important note is when the fair value of both the asset given up and the acquired is mentioned, it is presumed that both the fair values are equally evident. In such a case, fair value of the asset given up is considered as cost of asset purchased. Next, if asset is acquired by way of government grant, it will be recognized as per Ind AS 20. Subsequent measurement of PP. There are two models: cost model, revaluation model. Cost model. In case of cost model, PP will be recognized at cost less accumulated depreciation less accumulated impairment loss. In case of revaluation model, PP will be recognized at fair value as on date of revaluation less subsequent accumulated depreciation less subsequent accumulated impairment loss. Revaluation model. First, frequency of revaluation. If there are significant and volatile changes, revaluation should be done annually. If there are insignificant changes, revaluation should be done every 3 to 5 years. Next, treatment of accumulated depreciation as on the date of revaluation. When an item of PPE is revalued, the carrying amount of that asset is adjusted to the revalued amount. At the date of revaluation, the asset is treated as the treatment will be done in any of the two methods. First method, accumulated depreciation eliminated. Second method, accumulated depreciation not eliminated. In case of method number 1, accumulated depreciation eliminated, journal entries will be accumulated depreciation account debit to asset account and asset account debit to revaluation gain account. In case of method number 2, accumulated depreciation not eliminated. In such a case, following are the steps. Step number 1, find percentage of gain or loss that equals to revaluation gain or loss plus carrying amount. Step number 2, increase accumulated depreciation and gross block of asset by above percentage. Third one, journal entry, asset account debit to accumulated depreciation account to revaluation gain account. Next, revaluation to be applied to entire class of asset. If an item of PPE is revalued, the entire class to which the asset belongs shall be revalued. A class of PPE is grouping of similar nature and use in a entity's operation. Examples of separate classes are land, land and building, machinery, ships, aircraft, motor vehicle, furniture and fixtures, office equipment, bearer plant. Industrial building such as factories and office buildings can be classified as different classes of PPE since they have different characteristics. What is the treatment of revaluation gain and loss? Revaluation gain or loss. Treatment of revaluation gain or loss. In case of first time revaluation, revaluation gain will be transferred to OCI, NR, non-reclassified to PNL. In case of first time revaluation, if there is a revaluation loss, it will be transferred to PNL account. Next, subsequent revaluation. In case of a revaluation gain, previous year also there is some gain, revaluation gain. Then transfer current year gain to OCNR. In previous year there is a loss, then transfer current year gain to PNL to the extent it reverses previously recognized loss in PNL. Balance of gain, if any, will be transferred to OCI. Next, in case of subsequent revaluation, if there is a revaluation loss, In previous year, there is a revaluation gain. Transfer current year loss to OCI NR to the extent it reverses previously recognized gains in OCI. Balance of loss, if any, will be transferred to P&L. If there is previous year revaluation loss, transfer current year revaluation loss to P&L also. Next, transfer of revaluation surplus to retained earnings. Balance, if any, in revaluation surplus will be transferred to retained earnings. In case of excess depreciation means depreciation on revalued amount less depreciation on carrying amount if the asset was not revalued. That excess depreciation can be transferred to retained earnings. This is an optional. When PP is disposed or derecognized, transfer full balance of revaluation surplus to retained earnings. This is mandatory in nature. The above transfers will not take place through P&L. Next, component accounting. Since significant part of the PPE with a cost that is significant in relation to the total cost should be depreciated separately. Even if the cost is not significant, then also component accounting can be followed. If significant parts have same useful life and same depreciation method, then such parts can be depreciated together. When significant part or component is replaced, old carrying value of a replaced part will be derecognized and new carrying value will be recognized. Subsequent cost incurred. Subsequent cost like repairs and maintenance, that is day-to-day servicing cost, they will be charged to P&L as expense. Replacement cost. Replacement parts. In case of replacement parts, apply component accounting. That is when parts are replaced, derecognize old and recognize new carrying value. Next, major inspection and overhaul cost. It will be treated as a separate part and apply component accounting. In initial cost of PPE, the cost of inspection is already included. Therefore, depreciate that cost separately, applying component accounting. Whether further inspection is carried out, the cost of new inspection is recognized in the carrying amount of PPE and remaining carrying amount, if any, of the previous inspection is derecognized. Next, land and building. These are separable assets and are separately accounted, even when they are acquired together. Land and building. Land. If life is infinite, it will be considered as a non-depreciable asset. If life is finite, it will be considered as depreciable asset. Building is always depreciable asset. Depreciation. It is a systematic allocation of a depreciable amount to P&L over its useful life. Depreciation methods: SLM, WDV, units of production method. Depreciation based on revenue is inappropriate method. So, depreciation method should not be based on revenue. If it is based on revenue, it is inappropriate method. Depreciation period. Commencement of depreciation. Depreciation should be commenced when asset is available for use. Cessation of depreciation. That means when depreciation should be stopped. Depreciation should be ceased when asset is classified as held for sale as per Ind AS 105 or asset is derecognized, that is scrapped or sold, whichever is earlier. In such case, depreciation will be ceased. Depreciation amount. Cost minus residual value will give depreciation amount. Next, depreciation does not cease when an asset is idle or retired from use for sale, unless it is fully depreciated. However, depreciation may be zero under the units of production method. Residual value. It is the estimated value of depreciable assets at the end of its useful life. If residual value exceeds carrying amount, then depreciation is zero. Useful life. Number of years asset is likely to remain in service and provide benefits is the useful life. Useful life may be shorter than economic life. Next, annual review as per Ind AS 8. Accounting policies, changes in accounting estimates and errors. Depreciation method, residual value, and useful life should be reviewed at each financial year end. If any change, then it should be accounted for change in accounting estimates. Next, impairment. Impairment testing and impairment loss are accounted as per Ind AS 36. In certain circumstances, a third party will compensate an entity for an impairment loss. Example, insurance company for fire damage. Such compensation received will be recognized in P&L. Recognizing the compensation as deferred income or deducting it from impairment loss or from the cost of new asset is not appropriate. So it should be recognized in P&L only. Derecognition. Derecognition of an asset will be done when it is disposed or no future economic benefits are expected from such asset. Gain or loss on derecognition. How to calculate it? Net proceeds minus carrying amount. Such gain or loss calculated will be transferred to P&L. It should not be classified as revenue. It will be shown under the heading Other Income. Changes in existing decommissioning, restoration, and similar liabilities. In case of changes in cost of decommissioning that may result from change in timing or amount of outflow or change in discount rate, it shall be accounted for as under. Treatment of change in cost of decommissioning. If asset is measured at cost using cost model, increase in liability. If there is any increase in liability, it will be added to cost of asset. Entry will be asset account debit to provision for decommissioning liability. In case of decrease in liability, it will be deducted from cost of asset. Entry will be provision for decommissioning liability account debit to asset account. If asset is measured using revaluation model, in case of increase in liability, treat it as revaluation loss. Entry will be revaluation loss account debit to provision for decommissioning liability account. In case of decrease in liability, it will be treated as revaluation gain. Entry will be provision for decommissioning liability account debit to revaluation gain account.